Good morning, ladies and gentlemen. On behalf of 12 Capital, I would like to welcome you to our webinar on insurance private debt. My name is Mark De Filippi, and together with my colleague Vittorio San Giorgio, we will guide you through this webinar today. In view of the uncertain market environment, in particular with future inflation and interest rate developments, insurance private debt represents an attractive diversification with compelling returns. My colleague Vittorio San Giorgio will tell you more about this strategy in the next 15 to 20 minutes. He will dig into more details to elaborate why insurance private debt is resilient within an inflationary and recessionary environment. I will now hand over to Vittorio. Vito, why is private debt so attractive in the insurance sector?
Thank you very much, Mark, and good morning, everybody. The private debt space, and specifically the private debt space in the insurance sector, is extremely compelling for a series of reasons. First, the attractive returns that are achievable and were achieved in the past. And this is particularly true today in a higher rate environment and after the spreads widening we have witnessed over the past 12 months. And secondary, I think the very interesting point is that insurance as a sector as a whole is a particularly attractive one. And is very resilient to a recessionary environment, higher interest rates, and it also has proven very resilient to inflation. Let me jump straight into the returns achievable in the sector and achieved in the sector. If you look historically, and it would be the upper part of this chart, you'd see different asset classes in the fixed income space. You have sovereign, you have investment grade corporate, sub-investment grade corporate, and these would be cumulative returns over the past 5 years. You see our offering in the 12 insurance private debt space. It's clearly performing well, has performed with good risk-adjusted returns, with a relatively low level of volatility compared to other asset classes. If we move from historical to perspective and we move in the bottom part of the chart, you see the modified duration of the portfolio we manage, and also the yield to expected buyback yield to worst. You see 12 private debt offering has compelling returns, and you see that would be in the 7.5% to 8% with a very contained modified duration. And this is particularly important considering the environment where we are today, where you have still uncertainty on the development of interest rates, particularly in the upcoming month and year to come.
How do you manage such short duration issues from insurance companies normally have quite a long tenure?
That's a good point. We have different ways to manage duration. Please remember that a lot of the investments we make are typically having floating coupons. So the coupon adjusts automatically with the movements in interest rates, thus reducing the duration. We also have typically securities which have a reset of the coupon on the 5th anniversary, and they have a maximum tenure of 10. So clearly at the 5th anniversary, you'd have a reset of the coupon based on the prevailing interest rates at the time. And the other thing which is important, that the strategy has been launched 10 years ago, so we have quite a long track record, and the portfolios we manage already have vintages of transactions that are already gone through some of the years of life.
You mentioned on here on the slide that the sector is better positioned compared to the general corporate space. Why is that so?
This would be exactly the topic of the next few slides. Let me jump straight into the reasons why it is a good place to be, the insurance space. There are a few reasons, and I think I try to link these reasons to the current environment where we are. And if you think, for example, the higher interest rates environment, the insurance sector is positively, the creditworthiness of the insurance sector, and this applies clearly also to small and mid-sized insurers, which are typically the target of our private debt strategy. They're positively correlated to higher interest rates. You see here in this chart the development of interest rates over the past 5-6 years, and you also have the development of the solvency ratio of the insurers under our coverage. You see over the past years, since the introduction of Solvency II in Europe, you have had around 20-25 points of increase in solvency. the entire sector is moving up. So meaning that you've seen a better sector resilience and a further away distance from default. And this is very much linked to the increasing rates. Higher interest rates are positive because they allow for a better reinvestment yield on one end, and also on the other hand, they relieve capital requirements. So they allow for a release of capital for insurance companies. There are not many sectors in the corporate world that are similarly positively geared to interest rates. You have, in financial space, you have banks that typically benefit from higher net interest income. Clearly, the winners of the current higher interest rates environment in the corporate space would be the insurance sector.
But wouldn't rising interest rates impact the assets of the insurers?
Very much so. If you think about in an economic environment, typically these effects are neutralized, but also typically insurers have a slightly shorter duration on the assets, which allows for better investment yield. And again, I think the important thing to remember is also that higher interest rates allow for lower capital requirements. One important thing that I have to mention is that should interest rates spike up further, for some players, again, not the majority of the sector, there might be a negative correlation to interest rates due to increasing in lapse risk, surrender risk from life policies. But this again would be a limited amount of players over the total market that we're looking at. Another important topic, and I think this is key if you think about lending to smaller players today, and it's the fact that the insurance sector has a low leverage ratio and a high interest coverage. Why this is important? It is important because in a rising rates environment, you don't want to have you don't want to be lending to corporates which have higher leverage, because it means they would have higher refinancing needs, and these refinancing needs would happen at higher rates. And you don't want to lend to companies with weaker earnings and weaker cash generation, because clearly as the interest rates increase, the cost of debt increase, and these companies will struggle the most in a new higher interest rates environment. Insurance, and particularly the small and mid-sized ones we are looking at, which typically had limited access to debt capital markets, they have a low leverage ratio. So typically you'd have a 20 to 30% leverage ratios, and they have very cash generative businesses. Remember, the insurance sector is a mature one, and by being a mature one, it means that it also generates positive results and a quite rich set of cash flows.
Can you elaborate why insurance have less leverage than maybe other corporate sectors?
It is a combination of many factors. The smaller players, as I mentioned, they typically had a little bit lower access to debt capital markets. So the target market where we tend to invest into the insurance private debt space is a sector which is showing a little bit lower leverage. And secondly, insurance companies typically don't need senior debt financing for functioning. So they typically raise capital to sustain their capital needs. So they also need less working capital than many other sectors. Another interesting and important point, and I think that we're facing a recessionary environment today. We are, if we're not going through a recession, it's going to be anyway a slowdown of growth. It is important to remember that the insurance sector as a whole has the chances to outpace the growth of the GDP, and historically has been proving resilient to recessions, and you see a sticky level of gross written premiums for the sectors. Why so? The few important things that I'm showing in this chart. So this is the 10-year development of premiums per capita, which has been growing in all major economies. Two reasons. A, you have a series of compulsory type of insurance coverages you'll need to buy as a customer. This would be, for example, a term life coverage if you have a mortgage on your house. It would be third-party liabilities on your car insurance. And this is sticky, so you can't live without them. You have to buy them. So even in a recessionary environment, this is going to be a sticky block of premiums that will be written. On top of this, you have a protection gap in the in many areas. You have a protection gap in pension, so there is an incentive for people to buy more savings for their pension time. There is a protection gap in the health space, so people will be incentivized in getting complementary health, supporting the ones already received by the state. And lastly, they also want to protect their belongings, the house, the homes, particularly in those places which are more subject to natural catastrophes. So clearly the protection gap and the feeling of the protection gap will be supporting growth in the sector.
Can you elaborate on the growth in the USA? Is quite astonishing.
Material indeed. So there are a few things that you have to consider. This shows premium per capita, which is a combination on how much more contracts you buy, but also the cost of these contracts. So clearly in the US, you had an increase in the buying, but also an increase in the prices of these contracts. You can see, for example, what happened in some areas which are exposed to natural catastrophes that saw premium increases going up materially over the past years, and equally some other corporate type of coverage which has seen price increases which were quite material in the past years. Let me move on to the next point, which is, I think, on the top of every investor's mind: inflation. Inflation has been a big question for the insurance sector, has been a big question that was asked by many people on the underlying investments we have in our private debt strategy. And what I can say is that the sector has been quite resilient to the increase in inflation, and historically, the growth of premiums has been beating the growth of inflation. If you look at this chart, it's similar to what a real GDP growth chart would be. So basically, it would be the premium growth netted of the inflation over the past years. You see that the premiums has grown faster than inflation. What does it mean? It means that if premium grow, the top line of an insurance company grow faster than inflation, it also means that margins can be sustained, profitability can be sustained, and it's a sign of healthiness of the sector. What we have observed is that there has been a slowdown in this curve over the past 12 months. Clearly, it's due to the fact that inflation has spiked up, but also that there is a time gap, a time lag between inflation increases and the time when insurance company can pass on to policyholders these inflationary increases. The key message here is that we expect that in the future, albeit to a slightly lower extent, premiums will continue to grow faster than inflation.
Can you give example how insurances have absorbed inflation in the premiums?
Absolutely. So there are many examples. It goes from contracts where you have inflation embedded already in the wording of the contracts. Some geographies, for example, in Austria, in some of property contracts, or most of the property contracts, there would be a inflation indexation, which is automatic, which would mean that basically the customers would see its premium increasing in line of an index at the time of renewal. There are other cases where there is maybe some shortage of capital in the industry, for example, in the catastrophe space or in the insurance space, where there is so much demand for coverage that rates increases have been not only higher than inflation, but on top of that. So risk-adjusted rate increases over the past years have been extremely strong. There are some areas, and particularly more competitive markets, like the UK motor space, where passing on inflation to customers is a little bit more difficult and it would take a little bit more time. But overall, I think the key message is that inflation has been widely absorbed by the sector. There are also new line of businesses that we are looking at, for example, cyber, which has been growing materially more than inflation, and has also contributed to the previous chart that I showed you to the increase of premium per capita. So as people protect themselves against new risks. Let me move briefly to the other point that I thought it was particularly interesting, is the ESG-ness, pardon me the word, of the sector and also of the typical companies we lend to in the private debt space. If you look at greenhouse gas intensity for the sector, it is the lowest amongst the corporate sectors. And this sample is based on smaller companies that would be similar to the targets that we lend to in the insurance private debt space. This is level 1 and level 2 GHG. which means the emissions due to the own operations and the buying of energy. We don't show GHG level 3, not because there's anything to hide, but simply because there's a lot of discrepancy amongst reporting. So we can't show consistent data across the panel of sectors. And I think this will be evolving over time, and probably in a few years, we'll have much more solid data to show. What is important is that not only gas emission is low, but also the sector has been it's a regulated sector, so you have governance standards which are typically higher than those you see in other corporate sectors which are not regulated. But also, don't forget what insurance is there for. Insurance is there to close the protection gap. So by closing the protection gap, it means providing better coverages against risks, but also helping the reconstruction and rebuilding after insurance events happen.
Can you elaborate how these small and medium-sized insurance compared with larger groups?
Unfortunately, they're a little bit behind larger groups. You have large companies which have large teams of people dedicated to ESG and incorporating ESG into underwriting and investments. The smaller the companies, clearly the lighter the resources would be. Still, I think the starting point is a good one. And what we do at 12 Capital, we engage with companies and by engaging with them on topics which we believe are important from an ESG perspective, we also aim at bringing smaller companies, which typically have a bit lighter resources and be lagging behind, to a much better level and to a level which is more comparable to the larger players. I would like to maybe spend another couple of seconds on historical performance after I've shown you why the sector is well positioned in a market which is challenging with higher interest rates, potential recession, inflation. And you see here looking back at the performance that one of our products in the private debt space has delivered superior returns, attractive returns, risk-adjusted returns compared to other asset classes, and these are also shown a lower volatility, lower historical volatility. I would like to conclude by mentioning a couple of risk factors, which is also important. Remember, typically by being exposed to private debt in the insurance space, you'd be exposed to the typical risks that you'd have by allocating to fixed income, and also clearly concentration to a single industry, which, by the way, is intrinsically well diversified given the diversification between lines of businesses, geographies, and type of companies.
Excellent. Thank you, Vittorio. Just checking if you have further questions. That doesn't seem to be the case. You will find at the end our contact details at 12 Capital. We will be happy to answer any further questions you may have or talk to you directly. It is and remains very important for us to be close to our investors. So let me thank you very much for your participation, and let me wish you best regards from Zurich and say goodbye.
Thank you very much.